Hi class, we are still working on how to record bad debt expense and find a correct amount for the allowance account. I am working from the Wild Accounting textbook. I am on page 333 and we're going to take a look at Quick Study 7-7. Okay, so what is different about Quick Study 7-7 is that it uses the sales method to calculate bad debt expense and the allowance. When you use the sales method, see the whole point of even doing an allowance for doubtful accounts and recording bad debt expense is that we are trying to match our best estimate with bad debt expense in the same period that the sales happened that generated the accounts receivable that might not all be good. So we don't wait until we find out that somebody's going to file bankruptcy or go out of business and not pay us. We don't wait until we find that out to record bad debt expense. We actually use our past history of our rate of customers not following through. We use our past history and what we know about our current customers to estimate what might go bad out of this year's sales. So if we use the sales method, we are actually calculating the bad debt expense. We are not calculating what we want the allowance to be and then backing into the bad debt expense. We are actually calculating the bad debt expense. So it is much more simple. We calculate the bad debt expense and we just make the journal entry to bad debt expense, and it doesn't matter what the allowance account balance ends up being. Okay? We don't work backwards into what the entry ought to be like we do when we use accounts receivable. Okay, so problem 7-7 says that Warner Company's year-end unadjusted trial balance shows accounts receivable of $99,000. It shows an allowance for doubtful accounts, just like in the previous problem, of $600 credit, and we have credit sales, meaning sales where we billed people. They didn't come in and pay them cash. $280,000. Uncollectible accounts are estimated to be 0.5% of sales. Okay, so if I take 280,000 times 0.005, that would be 0.5%. Okay, that is going to work out to be $1,400. So $1,400 is the bad debt expense. I don't care that there's already $600 in the allowance account. When we use the sales method, see, companies use one or the other, okay? If they use the sales method, you make this calculation and then you don't care what's already in the allowance account. You just directly record this number as bad debt expense. And credit the allowance for doubtful accounts. Okay? Very simple. Okay, let's move on to problem 7-8, and we're going to make sure that we can calculate interest on notes receivable. And of course, if you can calculate interest on notes receivable, you could calculate them on notes payable too. Okay, so I'm looking at Quick Study 7-8, and it says that June Company receives a $6,000 90-day 12% note from customer Ryan Albany as payment on his $6,000 account. We're going to compute the maturity date for this note, and we're going to prepare June's journal entry for August 2nd. Okay? Okay, so if I have a 90-day note and we made it on August 2nd, is the start date, then let's figure out what the due date of that note receivable is going to be. $6,000, 90-day, 12%. Okay, so first off, when is this note going to be due? Well, August, if we did this on the 2nd, then we've got 29 days left. Okay, we've got 29 days left in August. If I add September, that's a 30-day month. That gets us up to 59 days. Okay, October has 31 days, and that actually works out perfectly to get us to 90 days. So October 31 is going to be the due date of the note. Okay? Now, the next thing we're going to do is we are going to prepare the journal entry that we should make on August 2nd when we loaned the money. Okay? And often what happens is we end up, like if we've got a customer that we really like and they get in financial trouble and they're paying us late, sometimes we might say, okay, let's take this out of accounts receivable and put it in notes receivable, and you start making payments on it, and then when you're paid up, we'll start shipping you more goods again and charge them interest. Okay, so sometimes you're taking it out of accounts receivable and putting it into notes receivable, and that's exactly what happened. They're already our customer. So on August 2nd, we're going to debit notes receivable for $6,000, and we're going to credit accounts receivable for $6,000 for that customer. Okay, so it'd be Albany. Okay, RA. Okay, now Quick Study 7-9 says, okay, now let's figure out how much interest they're going to owe us when they pay us October 31st. Okay, now you kind of have to watch because every author might do this a little differently. Some companies say that a year is 365 days. Some companies say that a year is 360 days because it's easy to calculate interest, because that's like having 12 30-day months. And if you give 90-day notes, then 90 over 360 is a fourth of a year. See what I mean? So your author in this case says to treat the year like it's 360 days. Okay? So here's the deal. When you see an interest rate given, it's always given for a year. It's what's called an annual rate. Okay? So they're not going to owe you 12% on $6,000. They're going to owe you a quarter of a year's worth of 12% on $6,000. Okay? So always start by taking the amount of your note, and I'm going to say this is our interest calculation. $6,000, okay, times 12% times 90 days over 360. 6,000 times 0.12 times 90 divided by 360. That'll give you a quarter of a year's interest at 12%. Okay, well, 12% on a whole year would be $720, right? So 90 over 360 is going to be a quarter of that. So it works out to be $180. Okay? Then that means that when they pay us back, we're going to get cash. We're going to get cash of $6,180. And we're going to credit the notes receivable for the $6,000 of principal that they owe us. And we're going to credit interest revenue for $180. See, doesn't that make perfect sense with what you know about making journal entries so far? Always start with what you're getting in, and they're going to have to bring us a check for $6,180. Okay.